It's a new tax year. Stay tuned for your tax playbook on how to get through 2026.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just everything your financial advisor won't tell you.
Welcome to a Wiser Retirement Podcast. I'm Casey Smith. Today I'm joined with Shauna Theriault, a senior financial advisor here at Wiser Wealth Management. Today we're discussing what tax planning strategies should you implement for 2026. Hello, Shauna.
Morning.
Morning.
It's very exciting stuff.
This is all very exciting stuff. We're prepping for this and we're like, wow, this is really boring.
I love tax. It's one of those things that I like it because it's challenging and it changes all the time.
Yep.
And it is like, people need help with it.
Well,
it's confusing.
Here's kind of some takeaways real quick. Stay tuned for this part. Is that we're going to give you some max numbers that you need to know.
Yes.
So, we meet with people all the time, and by September, they're like, "Oh, the max you can put in a 401k is $18,500, right?" And like, that was 5 years ago.
Right.
The number's very different
Right.
now. So we'll give you all these new numbers that you need to know for this year to help you make better decisions or make sure you're saving enough. So
well, exactly. Because in the beginning of the year, you look at your pay stub and what are you deferring? Like you should be looking at that at the beginning of the year. So
yeah,
absolutely.
Okay. So let's kind of talk about big picture. So many tax revisions that were questionable, I guess, over the last couple of years are now locked in. Really, we're just focused on inflation adjustments to those numbers.
Right.
2026, we're going to see higher income thresholds. We're going to see higher retirement contribution limits, new charitable deduction rules, and expanding gift and estate thresholds. So let's kind of start with some key numbers with the standard deduction. So this is where you decide, do I take a standard deduction on my tax return or do I itemize? This is now the new baseline.
Right. So single is $16,100. Married filing jointly is $32,200, and then head of household is $24,150. So most Americans don't itemize. Now there's going to be a change in itemizations, which we'll talk about that a little bit, which may make it so you can itemize, but the standard deductions are so high now that most take the standard deduction. So you really
know, what we missed here was the additional $6,000 if you're over 65 years old.
Yeah.
That's not on here. That's per person.
Yeah.
So think about that. If your income is low enough, you could have an opportunity to move income out of an IRA after your RMD.
Right.
That potentially could be zero tax.
Right.
If your income's low enough.
Right.
So you got to pay attention to that. Low wage. I want to say low. That's not super low, but
no, it's not.
Lower wage earners have the opportunities to get some tax-free transfers.
Tax-free transfers, yes, if you manage your other income and things like that, absolutely.
Yeah. So pay attention to your parents' and grandparents' tax returns and what their assets are, and you might have some opportunity there. Estate tax exclusion, does that say the same?
That went up from 14 million. It was like 13,999 to 15 million. This is the new permanent estate tax.
I thought that was a strange rounded number, so that makes sense.
I just started.
That's not an inflation number. That's just a new number.
That is the new number starting this year, and it's permanent. So that was what was supposed to sunset and go back to old rules, but now they made that permanent and passed it. Yeah.
So let's put that in layman's terms for everybody.
Yeah.
So if you die
and you have less than 15 million
per person,
then you do not have estate tax or inheritance tax. Now, some states have an inheritance tax, but there is no estate tax or inheritance tax on that, is what people refer to it as.
Yeah, we have much lower thresholds in the Northeast and some northwestern states.
Yeah. There's not very many states that actually have estate tax. So this is the federal estate tax limit, but there's some states that have it. I don't know, maybe a handful, maybe 10 if I had to guess. I don't know off the top of my head.
Yeah.
There's not very many states. You can go look that up and see if your state is one of them, but most states don't have estate tax either.
That makes sense. Most people are going, what?
Well, that's one of the questions we get when you inherit something is like, how much tax do I have to pay on this? Because I got this money inheritance, and it's like, well, if it's in an IRA, maybe, but other than that, it's not taxable. So.
All right. Annual gift exclusion. So this is money that you can give to someone, anybody.
Yes.
And there's no tax owed by either party.
Correct. And that's $19,000 a person. And I want to make it clear, and it's kind of confusing. So if you gift over $19,000 in 1 year to a person, you can, it's technically not taxable. You could just report the gift and just reduce the $15 million, because the $15 million is the estate tax exclusion, but also your lifetime transfer.
Yep.
So, if you gift more than that $19,000, it's still not taxable, but you're supposed to file a gift tax return and just reduce your $15 million, basically.
That's right.
So, we get that question quite often as well.
Yeah. So if you want to give someone $300,000, you write the check, give them $300,000, and then you can deduct that $300,000 from your $15 million.
Right. So you would just file a gift tax return, and then it would just reduce how much you can pass estate tax free in the future.
And is that good through this current administration, or?
No, it made it permanent.
It's permanent.
Yes.
So the only way to change it is to
change it again.
Which
it keeps happening. So
well, before it was inflation and it was going to reset.
Right.
And then it was going to drop.
Right.
But now we're solidly at 15 million.
Right.
Okay. Let's talk about tax brackets. Something that seems really simple, but people don't understand is the tax bracket. There's seven different brackets.
Mm-hmm.
It's progressive. Everyone thinks that if you make, so the top end is for married filing jointly is $768,000. So if you make $768,000, you are now in the 37% tax bracket.
Right.
Not everyone, but a lot of people assume that $1 through $768,000 gets taxed at 37%.
Mm-hmm.
That's not how it works.
No.
It's progressive. So the first $24,800 you made as a married couple is taxed at 12.
Right.
Then above 24 to 100,000, it's taxed at 22.
Mm-hmm.
So you have a marginal rate, like kind of what it all averages out to be, right?
Right.
But this is this is how the tax system works.
So you have your marginal rate, which is wherever you fall in. So,
that's right.
So if you fall into what you were saying, like
37%.
Exactly. That would be your marginal, but your effective rate is different.
Effective rate, yes.
Yeah. So it's really like how much total tax did you pay divided by your taxable income. And that is your effective rate, because you have those breakpoints.
Yep.
So your full effective rate would be less than the 37%, of course, but higher than the 12%.
So $768,000 is the top bracket at 37%, but really it's higher than that because you want to apply your standard deduction to that.
Right. Right. So you get your standard deduction, obviously. So that would bring down
that money is the money at zero tax.
Right. Exactly. So you get to deduct that against it too.
Yeah. $403,000 is the 32% tax bracket. 211 is the 24. 100 is the 22 for married. Single is a little different. Single top end is 640. Midpoint, the 32% is 201,000. So
yeah,
I don't expect anybody to kind of remember those. They kind of give you a visual picture of what that looks like.
Yeah. And really, how do you manage around the breakpoint? So it's important to know, if you're looking at, maybe Roth conversions or capital gains planning, maybe even smoothing out some business income, so that way you can kind of work within these ranges. So for example, maybe you feel maybe in the future, your required minimum distributions are going to be much higher and you're going to be in the 35% tax bracket marginal. That is. So, then maybe you'll want to do some Roth conversions now and use up the top of the 24% bracket. So the breakpoints just help you with overall tax planning. So it's good to know in the beginning. And sometimes we don't know because we may have bonuses that have not been paid out yet. So it's looking at this throughout the year is good. I like to do tax planning at the end when I'm thinking of Roth conversions in general. But there's other things to think about. We look at these tax brackets to go, okay, maybe should I be contributing to a Roth or a pre-tax? So you can lower your overall effective and marginal rate by doing, 401k pre-tax contributions. So that will affect where you fall in these numbers as well. So looking at what is my gross income going to be for the year, projected between myself and my spouse. And maybe, that helps you decide in the beginning of the year, where should you be contributing to?
Mm-hmm.
So, and understanding those breakpoints. So I think it's important to look at it just to understand where you're going to fall.
We know that capital gains gets taxed at either 15% or 20% or 23.8%. But if you have, let's say $100,000 in income, so you're right at the 22% tax bracket. But if you have $100,000 in capital gains, does that also push up your
It does,
your
'cause
overall
it's-
tax?
Yeah. So so that would increase where your ordinary bracket, but those capital gains are taxed still at the 15%. So your
Correct.
effective rate would still be lower, so it can push you up to higher tax bracket. But that portion of the capital gains is still going to be only taxed at like 15
it'll only be
or
taxed,
20.
but then your income would get taxed higher
Yes.
also.
Yes, it can.
So-
Absolutely.
So that capital gains will push you into the higher income bracket.
But you'd be
which
surprised
would-
how much you can have in capital gains before you're even taxable. Like, let's say you're retired and you have just capital gains,
Yep.
or whatever. Or maybe it's like, a young adult who doesn't have a lot of income yet, or isn't working yet, and they have a custodial account or something. You can have pretty high capital gains before you're even taxed.
Yeah.
Because it's really falls at 0 in the beginning. If you don't have any other ordinary income, it's like 0, 15, then 20.
Yeah.
So you can really, capital gains are great. And capital gains, it's if you're selling property, appreciated property, usually investments, and it's been held for longer than a year. That's long-term capital gains. That's the rates we're talking about. If you have
Correct.
property that's held for less than a year, that's short-term capital gains, and then it would fall in these brackets. So I
Correct.
just want to be clear. I think most know that, but just in case.
Yep. That makes sense.
Yeah.
Alternative minimum tax. This is something we really don't have to, I don't feel like we have to deal with that much anymore.
No, not really. Usually just, single, the phase out starts at 500,000, and then married filing jointly, it's over $1 million. So,
Yeah.
Many individuals and couples don't fall within those thresholds. Just the average American don't fall within those thresholds. Some do.
Yeah.
So,
Okay. Now the fun part when it comes to retirement planning, we get a little bit of a bump in our max deferral for our 401k plans. Last year it's $23,500. This year it's $24,500.
mhm.
So you can add additional $1,000 to that. If you're 50 or older, you can add an additional $8,000 to the 24,500.
Mhm.
And then here's the weird part. If you're between 60 and 63, you can add an additional $11,250.
Not on top of the 8, but
Not on
instead
top of the
the
8, but instead of the 8, you can put $11,250.
super confusing.
So if you're turning 60 to 63 this year, I would encourage you to take advantage of that, because
Yeah.
you can only do it for a very short time period.
I wonder why they just did that for a few years. That's so strange. I wonder if it's because of COVID and people got behind on savings or something.
I don't know. I figured there's a senator who wanted to put more money in his account.
Maybe. It just seems so random to me. I don't.
Yeah, it is
It
very
doesn't seem.
random.
I don't know.
Also this year, the Roth, the catch up has to go into the Roth now.
Oh yeah. So it is the catch up. Yes, for your retirement plans. If you're over a certain income.
Yes.
If you're over a certain income, then it has to go to either after tax or Roth.
Yeah, that's correct.
So
And your how that mechanism will work is all handled in the background by your 401k company. There's
Yeah.
not a whole lot you can do about it.
yeah, they automatically do it. Most people should have gotten notices by now
Correct.
from your company. If you were putting your catch up in, then, if you're over a certain income, then it would go to the
Right.
after tax or Roth portion.
Correct. Something I literally just got a phone call from my wife's school. So my wife is a school teacher,
Mm-hmm.
and it was HR, and she told them to call me because she didn't know. But
That's so interesting they would call you.
Teachers don't get a whole lot of pay, so take the percentage with a grain of salt.
Yeah.
But we want to max out her 403b, right?
Yeah.
So we contribute 48% is what I contributed last year. Well, in the meantime, they had a pretty sizable pay raise because this is a private school and they're all like severely underpaid. But I left the percentage the same.
Mm,
So what happened was the 401k got maxed out
yes.
by like October.
Yeah.
She didn't get any more matching from the
Mm,
half of October, November, or
Mm.
December, because her company does not offer, or her school doesn't offer, a true up provision. This
mm,
is again where wiser employees should be grateful that I think about these things. We have
Yeah.
a true up provision. So
Mhm.
if you tap out, you max out your 401k
get
plan by
the
July, you still get the
percentage.
match as
Yeah.
if you were contributing. And she goes, well, she wasn't contributing, so she didn't get the match. And I was like, look, I know what you mean, but at the same time, she maxed it out. Therefore, she could not put any more in.
Right.
So you guys should consider a true up provision. And she's like, thanks
Mhm.
for letting me know that,
Mhm.
but nothing's going to change.
That's a great point. So
So if
you
you're
need
not
to look
getting-
at that,
if you're maxing out your 401k plan, your company does not offer a true up. All the airline pilots that are listening, contractually, true up is put into your 401k plan. Please don't email me asking me afterwards. but yeah, if you're maxing out your plan, you need to make sure if they don't have a true up provision, that you're contributing at the proper percentage for the entire year. So every single pay cycle, you're getting the company match.
Yeah.
So I think her match is like, I think they match like 3%, is really low.
Yeah.
So she'd miss out on a ton of money.
it's still part of your
but
total compensation.
Yeah.
But if you're a higher income earner too, and you're over, I think the threshold this year is 330. I'd have to look up that number. But if you're over a certain dollar amount in the 300 range, then all deferrals stopped also. And the company doesn't match it anymore either. So
right.
it's kind of hard. So, if you're with a company that doesn't have that true up provision, but then also you have a high income and it has to stop at a certain point, you still may not max out. So you really have to time it correctly and looking at your pay to be able to get your deferrals in, which would save you tax if you're making that much money.
Right.
And then you may just miss out on the match if they don't have that true up provision.
Correct.
So,
which I think is normal. I think most companies do not have true up provisions.
Right.
So you just something we need to pay attention to is you want to put that money in over 12 months. So you get all the match.
Before we go back to the episode, have you thought about how taxes affect the inheritance you've been given? Download the Tax Impact on Inheritance, a free guide from Wiser Wealth Management. Understand your options, minimize taxes, and protect your legacy. Claim your copy now at wiserinvestor.com/guides. Let's get back to the episode.
You want to run through the IRA limits?
absolutely. So the contribution limits for 2026, the IRA is $7,500. And then if you're over 50, it's $1,000. So it's a total of $8,500. So, you know, it really depends. We get this question a lot about IRA contributions and can I do it? It depends, you know, if you have a 401k at work or your spouse does, there's certain rules surrounding that. It's very complex. So, you know, talk to your advisor about that. Generally, you cannot. You can make an after-tax deduction potentially to your traditional IRA. Then the Roth IRA phase-outs is, you know, between $153,000 and $168,000 single, and the married filing jointly is $242 to $252. So basically, if you're single and you make over $168, you can't do a Roth contribution, and if you make over $252, then you can't do a Roth contribution married filing jointly. You can do a backdoor Roth potentially. You know, there's specific mechanics surrounding that. You have to pay attention to what you have in IRAs already, because most of that could be taxable. If you make a, you know, non-deductible IRA contribution, subsequently convert it, is what that looks like. So still may not be a bad deal. You just want to look at that. So there's ways around that as well. You know, taking rollover assets and putting it in your 401k, for example, and making sure you don't have a lot of IRA assets to be able to do that. So there are opportunities to do that.
You could roll your IRAs into your 401k, and then that creates the opportunity to do backdoor Roths if you think that benefits you long term. So there's some planning that you need to decide. I think that hey, if you have the opportunity to do that, it sort of makes sense, but also don't discount the ability to just put money into a brokerage account.
Yeah. If you're a couple years from retirement and you're like, should I make this 2 years of IRA contributions? I'm non-deductible. I mean, maybe, but it may just be better served in a brokerage account if you need that money in the future, because you can invest it there too.
Right.
I think, you know, some individuals think it has to be a retirement account to put it in investments, but that's not the case. You can open a taxable brokerage account and invest there as well.
Yep.
I like having the multiple buckets anyway.
All right. Let's talk about itemized deductions, SALT, and the standard deduction test.
Yes. So this is basically, you know, what we were talking about in the beginning.
The SALT tax was pretty political in the last year or so. Right.
Well, the state and local taxes, you used to be able to deduct all of your real estate taxes, your state taxes, like our Georgia tax that we pay, and your local taxes if you live in city proper. And so they capped that at $10,000. So that's where, they raised the standard deduction and then they capped that and they got rid of a lot of the miscellaneous deductions that we used to have. And so that's why so many Americans are just doing the standard deduction because it's so high and those caps that they put on it where, they did increase that state and local tax deduction this year. That was part of the bill last year. And so now that cap has gone from $10,000 to $40,400. It's adjusted for inflation. So it's $40,400 for this year, but it depends on your income. So if you have income over $500,000, then it starts phasing out where you may not be able to do the $40,000. So to help with the higher income earners. So it's really, when you're looking at the so married, filing jointly, as we mentioned, the standard deduction is $32,200. So if your state and local taxes, which is like, your state taxes in Georgia, obviously if you live in Florida, there's no state tax. So, other states surrounding us, but then your real estate taxes as well. Then, it could be mortgage interest, charitable gifts. If it exceeds that $32,200, then you can deduct it. So, it's like many people would say, I want to do a charitable contribution to get a deduction, but they're getting the standard deduction. And so they're not really getting the benefit of the deduction, which is fine. You can still give to charity if you're charitably inclined, but you may not be getting the deduction you think you are because it's really the amount over the standard deduction.
Actually, that's our next topic. Non-itemizers can deduct $1,000.
Yes.
If you're single, $2,000 if you're married. And for the if you donate $5,000, it doesn't really do anything for you. The max is $2,000. The
max is $2,000 if you don't itemize, but if you itemize, then then you can obviously.
So the formula it would be your SALT plus your mortgage interest plus charitable gifts that exceed that threshold.
Well, then there's also but there's also medical deduction still as well.
That's true. 10%.
Yeah,
is that right?
What was it? 7 or 10?
It used to be 7.5. I don't know. Is it still 7.5?
I'd have to look that up. I don't recall because I don't know if it's changed this year. That's why I'm not sure.
But you have to hit that number. So if you make $100,000, you can't deduct any medical expenses until you're past $7,500.
Right. Exactly.
That's your zero mark.
Right. Exactly.
It's a lot of something.
Yeah. It is. It is a lot.
Especially if you have healthcare because your healthcare is covering most of the costs anyway.
Right. But a lot of individuals don't. So, or they have high deductible healthcare plans and the like. So, exactly.
Okay. Let's talk about, again, capital gains. There's actually a 0% bracket. Earlier I said 15, 20, and to 23.8 because if you're over a certain amount of threshold, you have to pay the Medicare tax, right? Mm-hmm. But there is a 0% rate for married filing jointly. If your income's less than $98,900, then you could have 0% capital gains. Mm-hmm. Now, this is where I kind of set you up earlier because I said, hey, if you have $100,000 in capital gains, that gets added as part of your income. So you really couldn't be in a situation where you took $100,000 in capital gains, even if you had zero income and still pay zero.
Yes, that's the power of long-term capital gains. But if you had $100,000 of ordinary income, that would not be the case.
Well, I'm saying if you had zero income,
but
you had, let's make it bigger, $150,000 in capital gains.
Right. Then it may push that up to the 15% threshold.
Yes, that's what I'm saying. You would still get pushed up to the 15% threshold for all of it.
Right.
Because it counts. It does
over that.
It counts toward income, but it's not taxed as income. Does that make sense?
Yes, exactly. So, I mean, this is a planning opportunity, I think, for, custodial accounts or individuals that have maybe, investment accounts with very little income outside of that, where you can actually reset your basis, if you will, where you can sell and reset your cost basis. I know that's a planning opportunity. Because if you're single, you can have up to $49,000 worth of capital gains before you're even taxed. You're in the 0% tax bracket for long-term capital gains, that is. So that is a planning point.
On our notes, I think we had a slight error. There is a 0%. There is a 15.
There is a 15. It's
There's
between
a 20.
that. Yes.
So
yes.
I'm like, what happened to the 15% bracket in my notes?
It's between 98. It's between 98 and that.
Okay. Yeah. So it's yes, right. So 15% between 98,000 and 545,000 or 613,000 married. If you make more than 613,000, then you're going to have, you'll be in the 20%
Right.
bracket
Exactly.
at that point.
Exactly.
So yeah, we typically don't want to do any. We're very capital gain sensitive in the 20% bracket.
I was going to say it's somewhat easy to manage your capital gains. It is, because nothing triggers a capital gain unless you sell it.
Yep.
So you can manage it like that. It's not like you can't control that, but you can also use losses to offset capital gains as well, and harvesting tax losses. When the market goes down, you would harvest those tax losses so you could use against future gains.
Yeah.
So, I mean, you can manage it a little bit better than, say, ordinary income being spit out that you don't control.
I'm having flashbacks to planning from last year, but there's always a decision to be made when you're retired prior to 65. So that means prior to Medicare, and you want to get the ACA subsidies.
Right.
But you also need to get out of these stocks that you've held for years and want to move to a more diversified portfolio. Right.
Yeah.
And so you have to make decisions on how do I take income?
Yeah.
So
if you retire early, let's say you retire at 55, I'm just making it up. And I'm seeing more and more people retiring younger, to be honest with you, I feel like recently. So if you're retiring at 55, you have that 10-year period where you have to pay for your health insurance before you start Medicare at age 65. And so it can be expensive. I mean, I'm seeing it run about $2,000 a couple right now. It's really, just for insurance.
For the full freight.
Exactly. So if you have so many individuals may have a lot of their money in 401ks or retirement accounts. So you don't get taxed on that until you make a distribution. And further, some may have Roths. So you could just pull it out and you're not taxed on it. So there's so many planning opportunities in that threshold. The subsidies through the ACA, the Healthcare Affordable Care Act, they give you subsidies if your income is low enough. So even if you have $5 million in a retirement account, they may give you subsidies.
That's the point. We'll get a little political here for a second. I have a client who is very much on the left-leaning spectrum of thinking, and they said, "I can't believe all this stuff with this year, and they're getting rid of a lot of these subsidies for healthcare for people. This is just terrible." And I said, "Well, from a planning perspective, let me give you a different angle on that.
Yeah.
I have clients that have $5 million in IRAs and Roths. They have $3 million in their brokerage account. They are well under the RMD age. They're in their mid 60s, right? Or before mid 60s or before 65, early 60s, let's say.
Yeah.
And they are, because they don't have any income other than the income coming from their dividends, which is relatively small, speaking, right?
Yeah.
It's well under $70,000 a year,
yeah.
even though we would draw $200,000-$300,000 a year.
Yeah.
Right.
Yeah.
And they have full subsidies in healthcare.
Yeah.
And she was like, "What?" I was like, she's like, "But there's an asset limitation on." I said, "No, there's not.
No.
There's no asset limitation.
I feel like it's broken.
You could have $25 million net worth and you could get full healthcare from the government."
Well, it's the same thing when you try to go get a mortgage, right? You try to go get a loan and it's like, you don't have any income. So
Right.
it's like, yeah, but I have like $5 million in retirement. I could pay this off, but I don't want to because
Right,
I don't want to pay the
tax.
tax on it.
Yeah.
So it's like, well, you have to show an income. And so it's like, it's the same concept,
then we have to like fake a withdrawal to be able to
start a subsequent withdrawal and
then stop it later.
Because they don't need the money because they're living off of stuff that's not interest, but lower
So
interest bearing.
The system's probably not someone did not think this through. And this has been this way for many, many years. This is not something new. It's always been this way.
I mean, it might be hard because there's so many rules surrounding, like, can you take it out early without penalty? It depends if it's in a 401k or an IRA, the rule of 55 versus there's probably so many rules surrounding it in our tax code that it makes it confusing. So they just have to draw a line in the sand and say it's based on the, taxable income.
And they probably don't have the manpower to be able to approve these things.
No.
By assets, if I had to guess. I don't know.
Probably not. I would think that,
because really all they're looking at is tax returns. So if you had more income the prior year than you claimed, then you have to pay some of that back.
True, because how would they manage that? Because they can just pull down IRS transcripts versus, you know what I mean?
You can't pull your asset list down
because they
easily.
do that. So they look at what is your income going to be for the year. This is on an ongoing basis. And if it changes, then you have to pay them back if you had subsidies. So
That's right.
how else would, I mean, I wouldn't think that, I think that would be really hard for them to manage that.
It'd be hard to means test it.
Right,
Yeah.
exactly.
Yeah.
So it's just.
Other than maybe your initial application. Maybe they could do it that way.
Right.
I don't know.
But then if you have a market correction and you did a bad investment, like, I don't know, I could see how that's so like gray.
Yeah.
Yeah.
Anyway, we're not going to solve that problem.
No, we're not going, nor do I want to try.
Just know that even a wealth management firm, we have to know the ACA because very wealthy people are able to do that.
Well, and then we have to manage the portfolio if it makes sense. Like sometimes it's like, well, you could save this much money, but if you could make more investing in this, then let's make more investing in this.
We've had clients in the past, they're over 65 now, but in the past that they had zero, almost, they were below the poverty line. Like they couldn't even get ACA. So we had to go in and sell securities for capital gains in order to push them above the poverty line into the ACA.
Wow.
Right. Otherwise they were going to be put on Medicaid. Nobody wants to be on that.
No, definitely not.
So you're doing this stuff and you're just like, shaking your head going, this is really messed up. Like these people, every one of these people can afford to pay the full premiums because that's how we budget their retirement.
But then what happens to us is that at 65, then they have Medicare and then they're like, well, I don't want to pay the IRMA tax. So if my income's too high and then I don't want to pay a bump, then you're paying more for your premiums.
You have to pay more for the same service, basically.
So,
it's, I don't know.
It's hard to manage for sure.
I would say make sure you maximize your 401k, $24,500, $7,500 into an IRA, catch up in addition if you're eligible for that. Decide early standard versus itemized, because if you do itemized and then you're going to need to, you might do charitable giving differently.
Right.
How you pay your state and local tax might be done a little differently.
And you do that like initially just looking at where's your target tax bracket, where's your income going to be for the year? And then it helps you decide where are you contributing for retirement accounts and should you focus on itemized or standing. You could bunch charitable contributions and things like that, So if your income is going to be higher this year because maybe you're getting a big bonus payout or some deferred comp or something, then RSUs, different things like that, then you could always, look at where that's targeted to be and then, itemize.
I would add to the list, go look at your tax return last year. If you owed money, was there a penalty because you didn't pay in enough during the year?
Yes.
If that's the case, go to your W-4 for your employer and make your changes there needed to make sure you get enough paid in to avoid the penalty.
Yeah. And so that calculation is called safe harbor. So it's okay to owe, but you don't want to have penalties because then you're just throwing money away.
That's right.
So you want to pay at least 90% of the current tax year estimate, or you want to pay 100% of last year. Now, if your income was over $150,000 last year, then it'd be 110% of last year. So it's really depending on what your income is. So if your income's lower last year than it's going to be this year for 2026, then maybe you make the safe harbor. You make sure that it's 100 or 110% of last year. Yep. If your income is going to be lower this year because maybe you had a big payout last year, then make it 90% of the current year. So just make sure it's okay to owe. So long as you're good at saving. You don't want to have huge refunds unless you're not good at saving. But it's okay to owe. You just don't want to pay penalties.
Correct.
And make sure you have the money to pay it during tax time. Obviously. So.
Yep. Use your capital gains threshold intentionally. So make sure that if I would flip that on its head a little bit. The market's had a great year, but there's still some mixed results. So if you have assets that can be sold for losses, then take those losses and reinvest elsewhere. But make sure that if you need to make changes and it is going to be capital gains, then maybe you can time it where you're not going into the 20% bracket. You can do it in the 15, or if you're already retired, maybe you can get some out at 0. You should take those allowances every single year. What I said earlier, I think at the beginning of this episode, is looking for opportunities to pull free money out. I think that older clients with lower incomes, our grandparents, things like that, are going to have great opportunities to do that. It may only be $5,000 or $10,000, but that's money you can pull out, reinvest somewhere else.
Yeah.
And not,
that doesn't mean take it out and spend it.
pass it to the next generation and, already taxed, which is very beneficial.
Yeah.
So I think that pretty much covers it. Shauna, thank you for your expertise in this area. And thank you for listening. Today's episode. If you're still learning more about Wiser Wealth Management or want to schedule a consultation, meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click in the link in the episode notes. See you guys next week.